Welcome back to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoen. Today we've got a lot to cover, and we will start with some breaking news from the Bank of Canada. They've cut their benchmark interest rate yet again, this time by 25 basis points, bringing it down to 4.5%. This is the second rate cut this year, and it's the lowest we've seen since April 2023. So, what does this mean for the housing market? Well, economists have been weighing in, and opinions are mixed. Clay Jarvis, who is NerdWallet Canada's mortgage and real estate expert, believes this cut won't significantly impact the housing market. He argues that an overnight rate of 4.5% is unlikely to unleash homebuyers' pent-up demand. Even with the reduction, variable rate mortgages at Canada's biggest banks will still be over 6%. Plus, passing a stress test at 8% remains a significant hurdle. Jarvis also pointed out that while fixed mortgage rates remain much lower than variable rates, they're still not low enough to get the market moving. Until variable rates fall by at least another 1%, they won't provide a more affordable option than what's already available. Penelope Graham, a mortgage expert at ratehub.ca, noted that current homeowners with variable rates are benefiting from reduced monthly payments. She said, "Those who've stuck it out so far with variable rates are being rewarded further today." However, she also pointed out that the overall impact on market activity remains uncertain. It remains to be seen whether this second cut will be the incentive homebuyers need to re-enter the housing market, she added. According to ratehub.ca's mortgage payment calculator, today's 25 basis point cut would lower the variable mortgage rate of a home priced at the average $696,179 to 5.45%. This means that the homeowner will pay $95 less per month or $1,140 less per year on their mortgage payments on a 5-year variable rate of 5.70% amortized over 25 years. The Chartered Professional Accountants of Canada highlighted the relief for Canadians with variable rate mortgages who can expect lower monthly payments. They noted that lower rates will significantly reduce borrowing costs for potential homebuyers. Karen Yolevsky, Chief Operating Officer of Royal LePage Real Estate Services Limited, expects a slight boost in market activity in the short term with more robust demand in the fall. With mortgage qualification thresholds continuing to come down, sidelined buyers may have the confidence they need to make their return to the housing market, she said. Yolevsky added that increased inventory in major markets could also encourage buyers. Victor Tran of Rates.ca believes the rate cut offers some relief for homeowners with variable rate mortgages, but may not significantly boost overall market activity. We would likely need to see another 25 to 50 basis point decrease before there is a significant uptick in sales activity, Tran said. Rates.ca noted that the rate cut comes as many housing markets across the country are experiencing slow sales and a dip in house prices, with home sales activity dropping more than 9% year over year in June. The Canadian Mortgage Brokers Association in British Columbia views the rate cuts as positive, easing financial pressure on mortgage holders and first-time buyers. Rebecca Casey, president of CMBA BC, stated, "We are optimistic that today's announcement will continue to ease the financial burden on homeowners and homebuyers while also empowering first-time buyers." Avery Schenfeld, chief economist at CIBC Capital Markets, suggested that the rate cut could lead to further reductions, potentially lowering mortgage interest and easing inflation pressures. The much-anticipated quarter-point cut opens the door to a further cut in September, he said. According to BNN Bloomberg, Yolevsky reiterated that buyers have been waiting for a concrete signal from Canada's central bank. A second cut to the overnight lending rate indicates just that, and with mortgage qualification thresholds continuing to come down, sidelined buyers may have the confidence they need to make their return to the housing market, she said. Yolevsky also noted that increased inventory in major markets could encourage buyers to re-enter the market. In the same BNN Bloomberg report, Graham pointed out that while the rate cut may offer new optimism, the overall impact on market activity remains uncertain. However, we did see a slight uptick in sales as a result of the June rate cut. Today's decrease could offer new optimism and stoke real estate demand, she said. Leah Zlatkin of lowestrates.ca is skeptical about significant market movement, highlighting that rates are still high and many buyers may wait for further cuts. We've seen a 50 basis point drop since June, but rates are still comparatively high, and many potential buyers are waiting for further rate decreases to increase their buying power before they make a move, she said. Victor Tran emphasized that the condominium market is particularly slow, with high rates dampening investment property interest. Interest in investment properties has decreased the longer rates remain high. Properties are taking much longer than usual to move, he said. Adam Jacobs from Colliers Canada sees the rate cut as a welcome sign that the worst is over and positive news for borrowers, real estate professionals, developers, and investors. Rate cuts should help in terms of making more rental development feasible and economical, easing pressure on the rental market more people can afford to buy, and inducing more sellers to list properties, Jacobs said. Mark Feeder from Avison Young Canada believes the Bank of Canada's announcement will positively impact investor sentiment. Commercial real estate return metrics are improving compared to other asset classes, and we expect this will further fuel investor appetite and capital allocation into commercial real estate, he said. Following the Bank of Canada's latest rate cut, most lenders have trimmed their variable rates by a quarter point. This means the leading variable rates are now just 86 basis points above the lowest fixed rates, compared to more than 150 basis points in March. This narrowing gap, along with expectations of more Bank of Canada rate cuts, will likely coax more borrowers to roll the dice with a floating rate. However, the spread will need to narrow further before significant numbers of borrowers jump on the variable bandwagon. It will be many months before we hit the 57% market share that variable rates had in 2022. For those who cannot stomach rate risk, insured 5-year fixed rates are now as low as 4.44%. Meanwhile, uninsured 5-year fixed rates have finally broken the 5% barrier and now sit at 4.99%. The best value in the fixed space remains the 3-year term, especially if you can find one at or below 4.99%. Fixed 3-year rates do not model out as well as variables in rate simulations, but many folks prefer their certainty through 2027. Robert McLister, a mortgage strategist and interest rate analyst, noted that the narrowing gap between variable and fixed rates is a trend to watch. He mentioned that while more borrowers may be tempted by variable rates, the overall shift will depend on further rate cuts and market conditions. Now let's shift gears and talk about the Greater Toronto Area's condo market, which is facing significant challenges. A recent report from CIBC and Urbanation reveals that a vast majority of new condo investors in the Greater Toronto Area are losing money every month. This report highlights a troubling trend for Canada's largest condo market. According to the report, 82% of investors in newly completed condos with mortgages are cash flow negative in the first half of 2024. This is a sharp increase from 77% last year and a dramatic rise from 2020, when only 40% of new condos were in the red. The financial strain on investors has grown considerably over the past few years. In terms of dollar amounts, investors who closed on a condo in 2023 are experiencing an average negative monthly cash flow of $597. This is a significant jump from the $223 per month for those who closed in 2022. Investors who acquired their condos in 2021 and 2020, however, are still managing to make monthly profits on average. The report also notes that about 30% of those who closed last year are losing more than $1,000 per month. The rise in negative cash flow is driven by previous increases in condo prices and higher interest rates. This has led to a sharp decline in new condo sales, which have plummeted to a 27-year low. The report's authors, Benjamin Tal of CIBC and Sean Hildebrand of Urbanation, describe this as the most significant test for the Greater Toronto Area's condo market since the 1991 recession. Despite the financial strain on investors and the increase in inventory, condo prices have not seen a major drop. Urbanation reports that unsold unit prices are down only 2.6% in the past year and 4.5% over the past 2 years. This suggests that investors are not in a rush to sell, despite their financial losses. Sean Hildebrand noted in an interview that he does not foresee a large number of distressed sales or foreclosures. He said, "Prices seem to be holding firm, which suggests that investors don't have a lot of urgency to sell. Instead, the biggest risk might be in future home building." Hildebrand pointed out that investors are crucial for new housing development in the Greater Toronto Area. If they are in a precarious financial situation, their reduced appetite for buying new units could severely impact housing supply. While many investors are currently losing money, the rental market remains strong, and interest rates are starting to decline. The Bank of Canada recently lowered its key interest rate by a quarter percentage point to 4.5% following a cut in June. This could provide some relief for investors in the near future. However, the challenges faced today are not entirely comparable to the early 1990s, when condo prices dropped 40% from peak to trough. Hildebrand emphasized that the current situation is different, with rates having peaked and still being considerably lower than they were back then. The report also highlights that condo ownership costs increased by 21% last year, while rents rose by only 8%. According to the authors, a combination of higher resale prices, rising rents, and lower interest rates will be necessary to turn the market around. In summary, the Greater Toronto Area's condo market is under significant pressure, with a large number of new condo investors facing monthly financial losses. While the rental market remains strong and interest rates are beginning to decline, the long-term outlook will depend on a balance of higher resale prices, increased rents, and continued interest rate cuts. Finding a budget-friendly place to call home in Ontario's grueling rental market can be a challenge, especially if you're searching for an accommodation that's close to transit, within a walkable neighborhood, and close to grocery stores or shopping centers. In an attempt to find the best cities in Canada for renters in 2024, real estate marketplace Point2 Homes analyzed 24 metrics spanning 3 categories across the country's 100 largest cities. For the report, the company observed the 100 largest census subdivisions based on the most recent data from Statistics Canada's 2021 Census of Population. Metrics were grouped into 3 categories, namely economy and housing, unemployment rate, rentership rate, quality of life, crime severity index, air quality, greenness index, walk score, and community, museums per 10,000 people, restaurants per 10,000 people. Despite standing out for certain metrics, none of Canada's top 10 largest cities, including Toronto, were deemed the best cities for renters in 2024. However, several Ontario cities stood out in the quality of life and community categories. Whitby, Oshawa, and Clarington were all ranked in the top 10 list of best Canadian cities for quality of life, while North Bay, Aurora, and Kingston were all recognized for their high community scores. Toronto ranked number 70 in the economy and housing category, number 40 in quality of life, number 25 in community, and number 44 overall. Here are Ontario's top 10 renter hotspots according to the study. Greater Sudbury, Whitby, North Bay, Guelph, Ottawa, Niagara Falls, Kitchener-Welland, St. Catharines, Chatham, Kent. These are Canada's top 10 cities for renters, according to the report. St. John's, Newfoundland and Labrador. Sherbrooke, Quebec. Quebec City, Quebec Trois-Rivières, Quebec Saguenay, Quebec Granby, Quebec Fredericton, New Brunswick St. John, New Brunswick St. Hyacinthe, Quebec Lévis, Quebec. In our final segment today, we have some exciting news for Ontario homeowners. The Municipal Property Assessment Corporation, or MPAC, has just launched a new online tool aimed at providing residential sales data. This new tool is called the Property Pulse Dashboard, and it promises to be a game changer for those looking to make informed decisions about their residential properties. So, what exactly does the Property Pulse Dashboard do? According to MPAC, the dashboard provides property owners in Ontario with the latest residential sales data right at their fingertips. Through About My Property, a free online tool for homeowners, all Ontarians owning property can easily access and explore residential sales data by municipality and property type. This includes single detached homes, semi-detached homes, townhouses, condominiums, and even waterfront properties. One of the standout features of this new dashboard is its Compare feature. This allows users to analyze sales information across up to 5 municipalities at once. Imagine being able to compare property sales in Toronto, Ottawa, and 3 other cities all at the same time. This feature can provide invaluable insights for both current homeowners and potential buyers. Greg Martino, the Vice President and Chief Valuation and Standards Officer with MPAC, emphasized the importance of this new tool. He said, "We are enhancing the information we provide property owners, allowing them to gain a better understanding of the residential market. This new tool, along with our recent release of housing inventory data, has been designed with property owners in mind so they can learn more about the changes to the residential property market in communities across Ontario and therefore facilitate more informed decision-making." For those interested in using the Property Pulse dashboard, you can register or log into an account at mpac.ca. This new tool is part of MPAC's ongoing efforts to make property data more accessible and useful for homeowners across Ontario. Well, that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. We've covered a lot of ground, from the Bank of Canada's latest rate cut to the challenges facing the Greater Toronto Area's condo market, and finally, this fantastic new tool from MPAC. As always, thanks for tuning in, and we'll see you next time.